Yeah, good afternoon, everyone, and thank you very much for joining into this monthly presentation. It's an interesting book named The Art of Execution, on which we have written the newsletter. So, obviously, I'll take you through the synopsis of that book. But first, let's kickstart with the portfolio performance. Starting with coffee can. So if you look at the 1 month return, it was minus 0.1. However, if you look at from a 6 month perspective, the returns have been closer to 9% versus the 5.5% return for the Nifty. The top performers in coffee can were Aisher, Zydus, and Ashok Leland. And the bottom performers were Trent, ZF, and Abort India. Moving on to the good and clean performance, the 1 month return was about 0.3%. The top performers in terms of the portfolio were Aegis, Chola Mandalam Investments, and Axis Bank. And in terms of the draggers were Trent, Page, and Supreme. Moving on to emerging giants, the monthly performance was -2. If you look at the 6 month performance, the return has been about 12% versus 8% for the benchmark, which is BSE 500. And if you look at small cap, it was about 10%. In terms of the top performers, here were Venus Pipe, City Union Bank, and Arvind. And in terms of the bottom performers were Techno Electric, Mastic, and EPL. Moving on to micro marbles. So if you look at the 1 month performance, it was at about 0.3. If you look at the 6 month performance, it was at about 10% versus 7.2 for BSE 500 and 10.9 for the small cap Nifty index. The top performers were Sunstar, Bajaj Healthcare, and Platinum. And the bottom performers were Globus, Everready, and Insecticides. Um, Moving on, so pricing prowess is our latest product offering. We have launched this AIF, which is a multi-cap fund, in the month of September. In terms of the return, it was at about a minus 0.8 versus minus 1.9 for BSE 500 and minus 1.8 for Nifty. Let's move on to the topic of the monthly newsletter. So there's a very interesting book called The Art of Execution, which we read recently. So we thought that we'll sort of write the newsletter on this theme. So if you look at in terms of reading material, there are lots of interesting books which have been written on how to pick a winning stock. However, there are hardly any books which sort of tell you how to behave in different market conditions in terms of portfolio allocation. This is one of the rare books which is a very easy read. In fact, it will not take you more than 3 days to finish the entire book. The reason why I say it is a very easy read is because it has a lot of live examples, which the author explains in a very simplified manner. And it tells you how to behave in terms of when your portfolio is in losses, and how to behave when your portfolio is into profits. And you can easily relate to this book because the author himself has been a CIO, and he's discussing on his live idea. So it's a very interesting read. But let me just sort of take about 10-15 minutes to summarize the key findings. So, why is it that just picking a winning stock actually, if you look at history, it's not that all of the stocks which you invest in will emerge as winners. So, let me just give you a few data points. So, if you look at global sort of stock market history, just 45 to 50% of the stocks actually give you positive returns, which means 1% return is also considered a positive return. So at any point in time, the probability of the stock giving you positive returns is just 45 to 50%. The next interesting data point is that just about 25 to 30% of the stocks in the portfolio actually deliver you alpha, which is return above the benchmark. And if you were to look at multi-baggers, there are only about 4 to 6% of the stocks in the portfolio actually emerge as multi-baggers, which means that bulk of the wealth generation in the entire journey is actually done by just 4 to 6 percent of stocks. So net what the author over here is trying to tell you is that if you just try to sort of hunt for the winning stocks, the probability is actually not very much in your favor, meaning that it's whenever you sort of enter into an investment journey, you should always remember that at any point in time, there will always be stocks in which you will be incurring losses. That is a part and parcel of your life. So it is very important to sort of adapt and take it with a truth that whenever you invest, there will always be stocks which will be loss making. So it's very important to sort of act when those stocks are loss making, and we'll come to that in terms of what to do when the stocks are actually loss making. Second, if you look at even the stocks which act as multi-baggers, so obviously everybody wants to invest in stocks which can become a 10 bagger, which means that you invest 100 rupee and it becomes 1,000 rupees. So everybody is in hunt of that particular stock idea. But what is important to sort of remember is that in that journey of a stock becoming a multi-bagger, there will always be instances of significant volatility. So if you look at sort of data, on an average, 8 to 12 times there will be a drawdown of at least 20% when you are into a multi-bagger stock. So it will never happen that you invest today at 100 rupee and the stock will in a straight line go to a 1,000 rupee. That typically happens only if you are a very lucky person, and typically the probability of you being lucky all the time is very, very minimalistic. So 8 to 12 times in your journey of a multi-bagger, you will see drawdowns of closer to 20%. In fact, on an average, what happens is that there is a maximum drawdown of 40 to 50% also, which you see in this journey of a stock becoming a multi-bagger. So, in any year, typically, if you look at a 10-year journey, there will be a few years where possibly the stock will go down 20%, but there will also be 1 or 2 year in that 10-year journey when the stock can actually correct by 40 to 50% as well. So generally, whenever people talk about stories of 10 baggers, they always talk point to point that I bought it in 2000, I sold it in 2010, I bought it at 100, I sold it at 1,000. But nobody will tell you that that 100 rupee stock also went to 70 rupee, or when that 100 become 300, that 300 again came back to 200. So obviously, typically, what I'm trying to highlight is that at any point in time, it will never be a straight line in which the stock prices will react. Moving on to the next slide. So if I were to give you live examples of companies like Infosys, HDFC Bank, Titan, all of them have been multi-baggers over a 10-year period. But typically during that cycle of them being multi-baggers, they have seen drawdowns of even 20% and even 40% in a particular year. So what I'm trying to highlight is that except the fact that in this journey of a multi-bagger, you will always have years when the stock is down 20% or even 40%, as has been the case with the names which I mentioned. In fact, if you look at Amazon, which has actually become a 1000x stock between 1997 to 2020, over there also, the stock has seen a drawdown of 50%, 6 times in that journey of becoming a thousand bagger. And in fact, there have been sort of 3 times when the stock has actually seen a correction of 70%. So one of them being global financial crisis, when the stock actually corrected by 70% in a year's time. So the journey to a 10 bagger is always filled with ups and downs. So the sooner you accept the fact that the stock will always see ups and downs, the better you will become as an investor. So let me move on to the next slide, which talks about what to do when the stock is actually not making money. Can we move to the next slide? Yeah. So what the author tells is that in an instance when the stock is not making money, there are actually three type of investors. One investor he calls as a rabbit. So what does a rabbit do? Rabbit as an investor will not act anything, meaning that if the stock is going down, he will neither buy more nor he will exit. Typically, a rabbit is an investor who will not take any decisions when the stock is actually going down. And according to the author, this is the worst investor possible, because typically what will happen is that such kind of an investor will always underperform. So it's very important to act whenever the stock is into losses. So what kind of decisions one needs to take? Coming to the second investor. So if you look at the second class of investor, he defines that investor as an assassin. So what does an assassin do? The assassin is an investor who typically acts with a stop loss. So either 20% can be a stop loss. So what that investor does is that if a stock is down 20%, without any emotions, the investor will exit. Or else what the investor will do is that he will have a defined period of time, that for 2 years I will remain invested in the stock, and if for 2 years the stock doesn't make any return, I will exit without any emotions. So this is the kind of behavior which you need to exercise when the stock is actually in the red. And typically such kind of decisions you can take when you are investing more into larger cap companies, because their liquidity is not a risk, meaning that you can easily press a button and you can sort of exit. So what the author tries to tell you is that if you are in a situation where your stock is making a loss, then you can work with a very disciplined stop loss approach. And there are two types of stop losses. One is that you have a defined loss and you exit, and second is that you have a defined time frame for which you will wait, and when that time frame is hit, you exit. And the third type of investor is called a hunter investor, which generally works in small caps. So what does a hunter investor do? That assuming that the investment thesis is playing through, but the stock is actually still in loss. So what will the hunter do? The hunter will double down. So for instance, if he's bought the stock at 100 rupees and if the stock goes to 80 rupees, simply you will average by buying more at 80 rupees. So the reason why this strategy works more in small cap and micro cap is because generally when the market mood is very bad, the liquidity suddenly dries up in a small cap or a micro cap sort of segment. So therefore, if you run with a stop loss, you will hurt yourself if you try to sell the stock unemotionally, because when you try to sell it, you will only bring the stock down. So conversely, what you can do is that you can actually put in more money, which is what we call it as top ups, and sort of bring your acquisition cost lower. Because typically, if you don't do that, then whenever the stock market were to rally again, you will only play catch up, and you will never make money. Moving on to the next slide. So in this slide is talks about what to do when you are actually in the green, meaning that the stocks which you bought are really doing well. So what the author tells is that typically there are just 4 to 6% of stocks at any point in time in your portfolio which will act as multi-baggers. So it is very important that you ride your investment journey with those stocks. So don't be in a hurry that you made a 10%, 20%, 25% return, and you want to book out the profits, because very the probability of getting a multi-bagger is very, very low. So when you are actually making good money, it is very important to ride that particular journey. So just to satisfy your adrenaline, what you can do is you can book periodical profits. So that is the way where you can sort of enjoy your gains as well, and also ensure that you also ride along your investment journey, which is in the profit making mode. So typically what the author tells is that if you are in a winning stock, then periodically you can book your profits, meaning that you can sell 10% of your stock when you are making 25-30% return. Then if the stock again goes up, then again sell 10% when you are making another 25-30. So by this behavior, what will happen is that typically you will end up enjoying the entire sort of bull run through which the stock generally goes. And typically, a multi-bagger stocks are such that people love to invest, because during drawdowns, typically when the market falls, even this stock will fall. But when the market comes back, these kind of stocks also bounce back very, very strongly. So therefore, it is important to enjoy like a connoisseur rather than exit very, very early. And in the end, the author talks about five winning habits typically that one should follow in their investment journey. The first being that rather than investing in the 50th or the 60th stock, it's better to invest in the most convincing stocks, which means that at any point in time, rather than running a 50 stock portfolio, you can run a 20 to 25 stock portfolio. Second, what the author says is that always have a position matters a lot, which means that always buy 2%, 3%, 4% in a stock rather than buying 0.2, 0.3, zero point 0.4. Because even if you were to get a multi-bagger, if you don't have a position in that stock, that multi-bagger will actually not make a material difference in your overall portfolio return. Third, be greedy when the stock is actually doing well. So rather than exiting at a 10-20% profit, basically do periodical exits rather than exit at one go. Fourth, whenever the stocks are making losses, either have a stop loss and exit, or double up your position. The worst thing you can do is just sit idle, pray to God that the stock market should come back. Typically, even if the stock market comes back, what will eventually happen is that your original price will come back, but you will eventually not make money. Instead, if you bring your acquisition cost down, at least even if the stock comes back to your original first purchase, you would actually have made money. And the last is that typically avoid investing in very liquid names. because eventually what will happen is that even if you like that stock, if you can't buy that stock or if you can't exit that stock, then there's no point in sort of investing in that idea. So I hope I was able to sort of summarize in terms of how to behave when typically the stock market either is in a very punishing mode, which is what has been the case in the last 1 year, and how to behave when the stock market is in a rewarding mode, which we believe will likely happen very, very soon. So I think I'll take a pause here, and I'll invite Trilok to take up the macro section.
So we will quickly discuss about the events around which is happening around us. I think so. This is a question in most of our minds on why India is not living to its potential. This is not something new. We have seen India sort of they having some underperformance in bits and pieces even in the past. But the good news here is we are obviously at the bottom of the underperformance compared to our own history in the last many years. If you'll see for that matter, then India's dollar adjusted return is actually amongst the worst in the last 2 decades now as we speak, in October 2025. Not only has that led to valuations converging to below long term averages, but also giving a lot of opportunity that will actually present our way moving forward. In fact, if you look at the history itself, there is a very high probability that the next 6 months to 9 months of returns it will be in high double digit. That's been the history, which 70% of the time market tends to deliver double digit growth after such steep underperformance against the global markets, and which is what our perspective is going forward. Now, what is going to drive this particular growth is what I will cover in the subsequent slide. Moving ahead, I think so. Two, three things are very clear. Moving to the next slide, please. The fiscal and monetary measures announced in the economy will have its impact beginning from H2. Clearly, RBI has done its job by giving 100 basis points cut. Income tax cut by the central government in the annual budget has already started to play out benefit in the common man hands. And third, GST, obviously, as we all see, and we have started doing some massive shopping in the last few days, the GST cut has led to people flocking towards the nearest retail shop. And I don't think so there's any doubt in our minds that the H2 will be super strong in terms of the growth in the retail segmentation. Now, just to add up with that, I think so one more lever that we are watching out closely is the eighth pay commission rollout in calendar 26. The last time seventh pay commission rolled out, we believe the average impact on the economy was 100 basis points, and we don't see anything different going to be happening in the next calendar year when this gets rolled out. In our assessment, nearly 1.2 crore employees will get benefit because of this single most important event in the last many years, and also the average hike will be 35% for a state and central government employee is what our understanding is. So this is a very important measure that will that will start having a very positive repercussion on the economy as we proceed going forward in the next 6 to 9 months. Moving ahead, when we look at from what's the another important monitorable event is the election right upfront, to beginning with Bihar. So Bihar is obviously going into state election next month, next particular month. But more importantly, in the next 6 months, there are I mean, until April 2026, there are five more states which are coming into election: West Bengal, Kerala, Tamil Nadu, Puducherry, and Assam. The most important point here is Bihar is the only ally that is actually helping the central government. Most other sort of states are either very small in context of contribution to Lok Sabha and Rajya Sabha seats, or are not, are in most cases central government does not rule in these particular states. So not only because of the fact that these states do not have a larger population or representation in the central government, we think there is a very low probability of any kind of populist measure being adopted either in the upcoming budget or in terms of run up to this particular state election. So we think the engine the push towards engine growth in the economy will continue, and government will continue to focus on consumption and consumption driven growth in the economy versus public capex. It was the theme in the last 2.5 years. Moving ahead from election calendar to what's being the nearest monitorable event, which is earnings. Earnings in this quarter has also been expected to be in the low single digit, in the mid single digit growth with 6 to 7%. I think so. It will not be very different compared to last quarter, but please bear in mind this quarter's earning growth should also be looked at in context of a 50% tariff that US imposed in the country. So we obviously started this particular quarter with an expectation of in deal negotiation getting done, but the discussion actually went haywire, and we obviously are staring at a 50% tariff as we speak now, 25 plus 25 versus an expectation of 15 to 17% earlier. So I think so in that context, the earnings growth seems to be quite robust in that backdrop. Moving ahead, I think the valuations is more important. As I showcased even in the earlier slide, our premium versus the emerging market have come down dramatically. In line with our long-term averages, Nifty continues to trade at 21 times, 21 and a half times 1 year forward, and we think the premium compared to its long-term averages in the mid and small caps will actually sustain, given the fact that earning growth will accelerate in the H2, and we think that 27 could be actually a very very strong year from a full year perspective, given the most important highlights that I covered in terms of direct tax benefit, indirect tax benefit, as well as eighth pay commission. So we think we are relatively optimistic on the outlook in the market. And with that note, I will probably hand over the floor to Umang for moderating the question and answer session. Thank you very much for your patience listening.